Hello, this is Brian Shannon from Alpha Trends Blogspot. It is Friday, the 9th of November, 2007. The market's closed. S&P 500 lost $1.86, another 1.25% today, and it was a tough week for the buyers of this market. It started out the week, if you remember, with bad news from Citigroup, and the market gapped down but quickly recovered. That was a really important warning sign, though. Look at this Citicorp, just almost no bounce at all. It was shows a green candle today, but don't get sucked into buying these types of stocks. They're in downtrends. They look terrible. If you remember, Countrywide, what was it, Bank of America or someone bought into them over, back in here. It was so-called great news, going to rescue the market. And now look at the stock. You look at Citigroup probably, in 2-3 months' time, and it may be lower than here. And if it is higher, the point is it's just too much risk to try and pick bottoms in the market. There's still some good trends, uptrending stocks, but right now the market's not rewarding that. Again, it's a tough week for the market, but the warning signs have been there. The market has been broadcasting a lot of warning signs, and hopefully you've been listening to that message from the market, because it's been pretty loud, basically, the message. Now you look at this trend line, it looks to me like it's busted, and this could bring in a lot more panic selling next week. We could see the market down towards that 143, which, if you remember, is basically the target from this head and shoulders pattern. And look at, again, from failed moves right here on October 31st when we had the Fed, and last Monday or whatever it was, come fast moves, and that's exactly what we're having happen here today. For some reason, this let's take a look. This chart isn't updated properly, so let's take a look at a 10-minute time frame because it closed much lower than that. Here's where we see that the market, again, declining 5-day moving average, guilty till proven innocent. Now, if you look at a 1-minute time frame, the market was above the VWAP most of the day, but late in the day we had some pretty severe selling come in right, in the last half hour when CNBC was calling for a short squeeze rally. So don't listen to the headlines, listen to the market. The market is the only thing that pays. And now it's back down to this 145 level. 148 to 149 is going to continue to be next week an important level of potential resistance for this market. If something happens that somehow gets back above there, I don't know what it would be, but you got to look at this as all these buyers have been trapped in this market right now. And I think that with a declining 10, 20, and 50-day moving average market below the 200-day moving average, any rallies in here are most likely going to be sold into by institutions. That's the way I view this market. Things can change, but they usually don't change that quickly. So you've got to continue to be very defensive in here. If you're going to trade the long side, it's just got to be for quick scalps intraday. There's, again, there's still some great opportunities on the long side intraday, but these rallies typically will fail to hold when you've got a much larger, more powerful downtrend on the longer-term time frames. The longer-term time frames take precedence over what you're seeing on the short term. You can trade the short term, but like I said earlier on my blog today, that these neutral ranges within an overall trend will typically resolve themselves in the direction of the trend on a greater time frame, and the greater time frame is lower. The semiconductors, this 450 has completely failed this week, and again, it's just a good lesson on why you don't look to buy at what should be support or what looks like support. The markets don't, the bottom of a market is a process, not an event. A lot of times, however, a top is an event, and tops can occur a lot quicker typically than a bottom, because the emotion of fear is a greater driver of action for most people than it is than the corresponding greed when you see a market starting to bottom. Don't fall victim to these rallies in here. Those are sucker rallies. They're, as my son would say, loser bait. So don't be a loser and fall for the bait, no matter how good they make it look, because there's a lot of people out there that are masters at making it look good. Anyway, let's take a look at the IWM. The Russell 2000 has been, over the last couple months, the most vulnerable group, I guess. And you can see here on the weekly time frame that it's right along this trend line, and it's looking like it's ready to break. We did see that 75 level, or I'm sorry, 76 basically tested this week, and it appears likely that we'll probably at least test these lows, maybe even further. If you look at this as a head and shoulders pattern, and you could just roughly say from about 79 bucks a share up to 84, we could say a breakdown from that would lead to 74 or so. So it still looks vulnerable, the Russell 2000 does, and again, this was the first group to really break down and broadcast a real message of weakness when it broke through that 78.40 level. 78 to 78.5 is going to continue to be the most important level of potential resistance for this market. We've got a declining 5-day moving average, and same thing here. At the end of the day, it came down. Not as bad, however, as the S&P 500, and actually the worst performing again today was the Nasdaq 100. Closed right at 50 bucks a share. Earlier in the week, I said it wouldn't be surprising to see a test of the 50-day moving average. And again, I'm going to point out a 50-day moving average or any moving average doesn't pay you. It's not a place to buy, to put bids in. A lot of times, it's an area where sellers will stop selling and buyers start to congregate. What a move to the 50-day moving average means is it's time to switch to lower-term time frames, shorter time frames that is. Look for evidence that the buyers are gaining control, and once they've established dominance on the short-term trend, then you take a position in the direction of that primary trend, and cover yourself with stop losses. Yesterday, it looked like this market was starting to recover, but again, a declining 5-day moving average, these rallies will typically fail to hold. And today, it was just a bunch of choppy back and forth action, kind of really battling with this daily VWAP in here. And it looked like maybe they were going to squeeze the shorts at the end of the day, but then sellers came in and sold this thing off very aggressively, losing almost 2% just in the last 30 minutes of the day. So still obviously a lot of panic in there. What's the next level of potential support? And it's only potential support. There is no support here until the buyers step up and establish dominance. So potential support, hey, who knows? Maybe it goes down to the 200-day moving average. Not a call, but the trend, the path of least resistance is lower. Now we're going to see that these levels are where we would expect to see resistance start to form on any bounces. Maybe it gets up into that 50, 75 or something like that. But we can start to look at some of these bigger picture Fibonacci levels too for potential support. If we take the lows from the from the August lows to the recent high, 50% retracement brings us down to 49.71. 61.8% retracement brings us to $48.55. There's still a lot of risk in this market. Many of the big leading stocks are continuing to break down. I said on my blog this morning that it wouldn't be unusual or unlikely to see Google or Research in Motion or Apple or some of the old leaders start to really break down hard and come down towards that 50-day moving average. And again, it doesn't mean buy at the 50-day moving average. Here's Baidu too. It means that's an area where there might be the potential for support to form as sellers just get tired of selling and buyers step in and say enough's enough. But wait for the big institutions to be done with their selling. Wait for sidelines big money to come in and let them do the dirty work of finding the bottom. Don't look for it in here. Wait till this 5-day moving average starts to flatten out. Let the institutions do the dirty work. As short-term traders, you hop in on those trends and take advantage when it's low risk. When it's not low risk, you stand on the sidelines, or you take the day off or do something more interesting than sitting there and watching your account implode, because that's what's happening to a lot of people who are trying to pick a bottom here. I said it for years that the toughest job on Wall Street is to pick tops or bottoms.